Welcome back, investors, to Ticker Time News. I'm Adam, and wow, just wow. Today was something completely unusual. Today's trade ended noticeably higher. We all can see that. Look at the chart on the screen. This is the 5-minute view of the S&P 500. But how it began is the complete opposite of how the day started. The September Consumer Price Index, or CPI report, it came in hotter than expected. And the S&P 500, the Nasdaq Composite, and the Dow Jones all fell between 1.9% and 3.2% shortly after today's open. Those were big moves down. However, the stock market staged a huge comeback after the S&P 500 broke below the 3,500 level, falling to 34.91. Get my number straight here. 34.91, just slightly underneath the 3,500 level. Look on the chart here right above my head. We've got this yellow line right here. We've got this blue line right here, and then this purple line right above it. All three converging practically just about within a few points of each other. All three lines. The orange line is the 3,500 level. The blue line is the 50% retracement of the pandemic rally. And the purple line is the lower end of the weekly expected move, all for the S&P 500. All three of those lines should have told us, I should have known yesterday, that with those three lines converging, just like at the top, let's go to the daily view on the S&P 500, the ticker symbol SPX. That's what I'm using here. I'm not using the SPY right now. I'm using the SPX. These 3 points converging at the bottom, okay? And when we go to the daily view, it looks like they're all together squished right there. Those three levels should have told me yesterday that, you know what? When we reach the top of the summer rally up there, we had three converging lines saying that, no, we cannot go higher than this. This is going to be a strict resistance area. I've been saying for weeks that 3,500 is going to be a super strong support level. I should have seen this coming, but I didn't. I missed it. I knew it would be support. However, I didn't see today in this 2.6% jump in the SPY, the 2.3% jump in the Qs, or the 2.4% jump in the IWM, or the 2.8% jump in the DIA. Those are all the S&P 500, the Nasdaq, the Russell 2000, and the Dow Jones. Now, the 3,500 number is a number that, like I've said, we've been talking about for weeks, and how strong that area of support should have been. And it was. But I have to admit, I never in my wildest dreams expected a bounce this strong with higher inflation numbers to boot from the 3,500 level. So I need to dissect today to understand why this bounce occurred. And I found a few things. Now, it seemed that the rally was driven by technical buyers stepping in when the S&P 500 fell below 3,500, which, like I mentioned at the beginning, which effectively marked the 50% retracement of the pandemic rally. Again, we've been talking about this level for weeks now. The S&P 500 put in a new intraday low for 2020. 2022 as well at 34.91 before it started on its massive rebound. And that rebound, which saw the index climb back above 3,600, we closed at 36.69. That was a full 100 point plus move in the SPX. Over 100 point move in a day from trough to tip. And it was likely helped out by short covering activity. You see, after digging into the data from today, because I had to understand this, I want to learn something new every day. That's my daily goal. But this bounce, this strength from that support, I have to understand exactly how this happened and why it happened. So after the market closed, I went digging through chart after chart and data after data. And once the market started to rally, let's go back to the 5-minute chart here for the SPX, S&P 500. This is today, okay? The big drop in the morning and then the big rally. Once that rally started this morning, those who shorted the market had to start covering, causing a cascading effect, which led to a short squeeze explosion to literally take place today. Today was crazy. Crazy stupid. Absolutely. Throw that one up there. But no matter how stupid or crazy it was, I've got to understand this. I have got to understand this. And this mark right here, this is where all the algorithmic trading computers, they all stepped up and took this short squeeze to the next level. That's what those big candles right there represent. It's the computers shifting on, turning on, recognizing the pattern, recognizing that, hold up, 3,500 is programmed in. As soon as it hits, we've got to start buying. Buy, 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 buy. And it caught a bid. And then once that bid caught, it was like a brush fire. It just took over. Completely and utterly took over this morning. And like I said at the beginning, in the face of high inflation. Now, something that's hard for market participants to track and understand. To understand its effects on the market, especially those who are new to investing and new to trading. Price action in the treasury market, in the UK gilt market, and in the currency markets all supported the rebound effort. Reports emerged before the open that UK's Prime Minister, Liz Truss, might scale back her fiscal stimulus plan, tax cuts, which gave some much needed relief to the gilt market and the British pound after recent volatility that it's seen. The 10-year gilt in the UK, the yield fell 33 basis points to 4.19% on the news. So something taking place across the pond that new market participants don't know to pay attention to was having a direct effect on our stock market here in the States. The US dollar index, ticker symbol DXY, it peaked at 113.92 shortly after the CPI report. It was down 0.7% to 112.5, which ultimately helped to push the stock market higher. Treasury yields also peaked shortly after the CPI report, but pulled back from those levels. The 10-year yield, which reached 4.07% this morning, settled at 3.95%. That helped the Qs to take off. The 2-year yield, which jumped to 4.52% 4.2% this morning after the CPI report, settled at 4.45%. Then a reversal in price action for semiconductors, for mega cap stocks, mainly Apple. Apple was up 3.4% today, were very important drivers for this rebound effort. Apple was down 2.9% at its intraday low. In the Van Erik Semiconductor ETF, ticker symbol SMH, it was down 4.9%. And then this semiconductor ETF, it ultimately finished with a 3% gain. That's nearly an 8% move from bottom to top. That's huge. I can't understate that anymore. That was huge. Taiwan Semiconductor Manufacturing Company, ticker symbol TSM. It was up 3.9% today. It was a top performer in the semiconductor group after it bucked the trend and reported favorable quarterly results and guidance. Another support factor for the rally was the strength in the S&P 500 financial sector. We mentioned this yesterday. Financial sector and energy sector have big weights on the S&P 500. Not so much with the Qs or the IWM, but with the SPY, it can have a big effect. Well, the financial sector was up 4.1%. And it ended at the top of the leaderboard, but just slightly ahead of energy. And I'll mention that in a minute. BlackRock, ticker symbol BLK, it was up 6.6% today and was a winning standout for the group after reporting quarterly results this morning. Jpmorgan Chase, ticker symbol JPM, up 5.6% today. It was another notable leader, and it's going to report its results tomorrow at the open. And of course, we had Jamie Dimon, the CEO of Jpmorgan Chase, come out today at a conference and talk, and he was doom and gloom for this market, especially in 2023. But he did say that consumers have the money right now, and they can spend the money right now. However, next year, he thinks that inflation will finally take its toll on the consumer. So he's really preaching that doom and gloom for 2023. We'll see how it plays out. Now, on the flip side, the consumer discretionary sector, ticker symbol XLY, it was up 1% today, which was the smallest gain today among the S&P 500 sectors. However, it ended 5.3% above its lows of the morning. Wow. Just wow. Let's get to some of these comments here. I don't want to miss them because today was something else. I should have kept to my game plan. See, let me run through this real quick. Looking at today's economic data, because what you said right here about sticking to your game plan, I have a thought on that, but I want to finish this thought right here on this data. Total CPI rose 0.4% in September. The expectation was only 2%, so it doubled, following the 0.1% increase in August. Core CPI, here's the problem. Core CPI excludes food and energy, but it rose 0.6% in September. The expectation was only 0.4%, following a 0.6% increase in August. On a year-over-year basis, total CPI was up 8.2% versus 8.3% in August, and the expectation of 8.1%. But core CPI, it was up 6.6% versus the 6.3% in August. So the takeaway here is that the the recognition that core inflation has gotten worse, driven by widespread pricing pressures that included another 0.7% increase in the shelter index, mainly due to rents. This understanding will cement expectations for a 75 basis point rate hike at the November FOMC meeting and stir worries that the Fed will stay on an aggressive rate hike path longer than hoped. So with that news, the market rallies. This was computer trading off a very important very technical bottom. Then weekly initial jobless claims totaled 228,000. The expectation was 225,000. Not too far off, but last week's was only 219,000. Continuing claims totaled 1.368 million after last week's revised total of 1.365 million. The key takeaway is that the initial claims are still running at a relatively low level. That suggests the labor market continues to run hot, or at the very least, too hot for the Fed's liking. Then, weekly EIA crude oil inventory showed a buildup of 9.88 million barrels after a 3.36 million barrel draw last week. This helped to lift the energy sector, ticker symbol XLE, up over 4% today. WTI crude oil futures bounced off its trend line and its 50-day moving average to land 2.5% up today. Now, ahead of Friday's open, Jpmorgan Chase, Wells Fargo, Citigroup, and Morgan Stanley will all headline their earnings reports. Market participants will also receive the following economic data. At 8:30 a.m. Eastern, the September retail sales report. The expectation is a 0.2% increase. The prior reading was a 0.3%. Retail sales, excluding autos, the expectation is a flat line, 0%. But the prior reading was a negative 0.3%. Then at 10 a.m. Eastern, the August business inventories. The expectation is 0.9%. And that's up from the last reading of 0.6%. And then the preliminary October University of Michigan Consumer Sentiment Survey. The expectation is a 58.6, and that's exactly where it was at its last reading. This will certainly... All right, let me take a step back. I should have kept to my game plan. Today was certainly one of the most unusual days in market history. So whatever happened with your trades today or your game plan, whether good or bad, don't ever forget the lesson that it taught us. For me, whenever the market is at a key technical level, be patient. Wait to see how the market reacts. Sometimes it will fall big to support, especially to an extremely important level like today's 3,500 in the S&P 500, and the market might just move sideways. But other times, the market may bounce. And that's why being patient and waiting for confirmation is so critical. Sticking to your game plan and not letting off of it. If you make a mistake, you learn from it. You move on, you update that game plan to include the lessons learned. That's what I'm doing today. I'm updating my game plan from the lessons that I learned today. Okay. Should have kept my game plan. Let's put this one up. Sold my calls at the open and closed my puts too. A little late there. Okay. This, I do believe. How was this predicted? Could this have been predicted? We are in a time in history, in a market that is so confused, so frustrated, that I think it doesn't know what to do. Today was not logical. Hot inflation does not equal a rally. This is computer trading, I think, and a short squeeze on top of that. Things happening across the pond affecting our market. Bond market in the UK affecting our markets here. It's crazy. Is this a ticker symbol you want to check out? Let me go back to the daily view here. I made money today. I could have made more, but greed took over. Don't ever worry. Let me throw this up here. Don't ever worry about missing out on what you could have made. Be content with what you did make. That is, that's a lesson that I learned many years ago. Is you make a trade and it's working for you, it's going in the right direction, and then you feel like it's gone far enough, so you take your profits. That's not bad. And then you see that the market continues to run up and you think, oh wow, what's going on here? FNGR. It's an interesting, I haven't heard of this company before. Whoa, it's been moving. Holy moly. But what goes up must come down. A 92.8% on Monday the 3rd. Yeah. I'll be quite frank right here. This could very well, finger motion, technology, packaging, software, or package software, my apologies. $8 stock, volume 2.4 million. What was the average volume back here? 85,000 to 2.4 million. This right here is short squeeze. This is short squeeze territory for a company like this. Small cap like that. Mobile payment and recharge service in the China market. I definitely do not mess around with Chinese. I mean, see, it's headquartered in New York here, but I don't typically mess around with companies in China, especially those who have a big market or their majority market is China. What about news here? Is there a reason why? No. Finger motion to list on Nasdaq on Tuesday. That was December of 2021. This is all old news. Yeah, I mean, this just looks like a typical short squeeze. I don't see off the bat here anything noteworthy that would cause the company to move up here. I can do a deeper search to figure out what in the world's going on here. But that's definitely a short squeeze. And just remember, when these occur, what goes up must come down. And usually when they run up fast and hard like this, they come down just as fast and just as hard. Let's see here. I'm gonna dig in here a little bit, but I'm gonna look at these questions right here. Yeah, I told myself I would let both sides ride and not close the losing side out. The market will rally until the next FOMC meeting. That's a good little point right there. That's a good point. The market will rally until the next FOMC meeting. Remember when I had and I think actually I have it right here. When I had the seasonality, yeah, right here, the seasonality chart up, and we were talking about this. Usually the first half of October, we get that rally. And then let me get the marker here. We're looking at the red line, right? So typically in our situation, the first half of October, that red line, we see a rally. Now, this doesn't have to be, or this isn't, how should I phrase this? The dating on this, it can shift around a little bit, right? But usually we have a lot of FUD, a lot of fear, uncertainty, and doubt leading up to big elections. And we have a big midterm election. And that typically sends the market down. So that's why I find your comments very interesting. The market will rally until the next FOMC meeting. The next FOMC meeting is November the 3rd. Did I write that down correctly? Is it the 2nd and 3rd of November? Gotta get my writing utensils out of the way here and get my big notebook. My big notebook with all my notes on it. See? It's got all my notes here, all the different companies I track and so forth. I always keep a notepad right by so I can November 1st and 2nd. But I always keep a notepad full of companies to track and whatever trades I'm doing throughout the day. You know, I always like to use technology, but, you know, I like to be analog too and write this stuff down, because sometimes you can see something that's like, oh, yeah, let's write that down real quick. And then boom, 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 you're back in the charts doing something else. And you want to remember that. So even though the seasonality chart for where we are currently in this midterm election year, even though this red line right here has been spot on, it caught the June low, it caught the summer rally, it caught the sell-off, and then the September low, nearly to the T right here. It can be adjusted slightly, right? Like it's a moving slide when you have the date. So this big fall right here leading up to the midterm elections, that's historically, going back to 1946, how the market typically reacts to all of that FUD, all of that uncertainty and fear of the election itself. And with the next FOMC meeting being the rate hike decision will come out November the 2nd, that's very interesting right there. Because then what you could be looking at here with your comment, the market can rally until the next FOMC meeting, that maybe this drop off right here that is typically seen towards the end of October, maybe, and let me, can I do, what will that, oh, there we go. Maybe instead of that drop off happening at the end of October, maybe that drop off, you know, moves over to the left a little bit, right? Moves over this way some. Trying to make an arrow there. And maybe the drop off comes at the FOMC meeting, and then we get that drop off. Because if you look at this chart, yes, it does have that drop off there, starting in the middle of October to the end of October, but there's also a sell-off period right here, right? So maybe we are in a section where we made this new low, right? And it's on the seasonality chart. Mid-October, there's a new low. We're close. It's 13th of October. And maybe we're going to rally then and not get this super low until the FOMC meeting. And then we have our sell-off. Maybe the market, maybe the, not market, maybe the central bank fools us into a security of feeling, well, they're going to raise 75 basis points. What if they sneak in and do a 100 basis point rate hike on November the 2nd? What would that do to the market, right? What would that do to the market? So that's very interesting. All right, let's see here. Going back and forth here. What prompted market makers to run like this? Let me hide this down and let's go back to SPX. Okay, so there was what, and let me say it this way. I said it at the beginning of the live stream, but that's fine. Remember at the peak of the summer rally, okay? Back here in the middle of August, we had a trend line coming down, okay, that had been resistance, right? Almost like we're in this megaphone pattern here with these trend lines. It acted as resistance before, okay? So we had that. We also had the 200-day moving average. Oops, move, take you off. We also had the 200-day moving average at that time coming in. And then we had another trend line, this one right here. And all three of those, there was a trifecta of resistance points at that moment in time. And that was the top of the summer rally. It stopped it in its tracks. Well, what happened right now is that we just got a trifecta of not resistance, but a trifecta of support. Okay, so let's go into this a little bit closer here just to make sure that it's clear. And here's the trifecta that we had. Three things. Let me open this up a little bit more here for where we are today. All right, number one, we had the 3,500 level. There's an orange line at the bottom here. It's marking the 3,500 level. That is a very technical level of support. If you back up, and we'll back up here and go to that 3,500 level. Gotta tighten the chart up here just a little bit. This blue box over here above my head, okay? This right here, 3,500, acted as a resistance area, okay? Old resistance becomes new support, all right? So that's the 3,500 level. The second is that the lower end of the weekly expected move, which is the purple line, is right there at 3,515. All right. And then the third line is there's a blue line, and they're all running together right here. That blue line right there was the 50% Fibonacci retracement level of the pandemic rally. So from the March 2020 low to the January 2022 high, 3,500 was the 50% retracement level of the pandemic rally. So we had a trifecta of support at 3,500. The computers caught that and sent the market bidding it up even higher. That's one of the reasons why the market, it stopped right there and it didn't go lower. Okay. I know it went a few points under 3,500. It's always a little zone that you play with. So that's one. Number two is the treasury market, the UK bond market, the currency market, all help to support a rally today. And I talked about the specifics of why those mattered at the beginning of the video. So those are a few of the reasons for why it stopped right there, it bounced right there, and why it was such a strong bounce. Algorithmic trading played into that 3,500 level being a very key level. Let's see here. I don't want to miss any of your questions. Want to keep rolling with this. So if you have questions, plug them in and we can rock with this. Today was definitely a very unique day in market history. It'll definitely go down in my book as one of the craziest days. Okay, yeah, I also think this market is getting... hold on, did I read that wrong? I should have my glasses on for this. Yeah, I also think this market is going to get bullish tunnel vision like it did back in the summer. Agreed. And if you look at the seasonality chart, remember there's a drop off in mid-October to a new low for the year. We got that in mid-October, okay? Yesterday, just yesterday, we set a new low for the year. Today, we set a new intraday low, but the closing low is the most important one. So we set a new closing low for the year yesterday, just like the seasonality chart here for a midterm election year like we're in also points out, okay? And again, just to point that out, it's this little dip right here, and then there's a short little bounce before making a new low for the year. Now, this bounce, right? We drop down to a new low for the year on the seasonality chart, and then we get a bounce from that new low. So could today have been, we set that new low yesterday, okay? The new closing low yesterday, and then the bounce today is that bounce, and then what comes after that bounce but a new low for the year that undercuts that low and takes us down even further. And this, on the seasonality chart, all happens before November. November 2nd is when the Fed will come out and hike rates. And let's just pull up this real quick just to see where we're at. CME Fed Watch tool, type it into Google. It's typically your first link there. We'll let this load. This will show you the probability of what the rate hike will be at the next FOMC meeting. So we'll get that. I think tunnel vision will be really, really easy for bulls to get, especially market participants who are new to the world of trading and investing. Whoo, boy, a lesson to learn today. It is something. This is major volatility. Moves like this. Holy moly, look at that. Okay, so the November 2nd FOMC meeting. Right now, there is a 96.3% probability that we will get to 3.75 to 4%. Okay? Yesterday, it was a 84.5% probability, and that's a 75 basis point rate hike. There is a 3.7% probability of a 50 basis point rate hike. And yesterday, that 3.7% was at 15.5%. A week ago, that 3.7% for the 50 basis point probability was at 25%. A month ago, after the FOMC meeting, it was a 35% probability of a 50 basis point rate hike. And now that's down to a, let's call it 4%. there is a 96% probability of a 75 basis point rate hike. And I, right now, would not be surprised with how inflation came in today, as hot as it did, that the Fed might do a rug pull and trick us. Instead of doing 75, let's just do 100. Let's just do a full basis point rate hike. The Fed wants to get to over 4%. With inflation coming in hotter than expected, why not just go to 4.5% by the end of this year? It's always a possibility. All right, let's keep going right here. I think it started a short squeeze. I do think that a lot of today, and let me get that up here on the screen. I do think a lot of today was a technical short squeeze. The one thing that has me not sure about it being a short squeeze because there were too many. All right, let me back my thought up here. If we look at the IWM, okay, which is the Russell 2000, that's your small caps, right? It was up 2.4% today. The SPY, which is 500 companies, very spread out. You got mega caps and you got mid caps. The SPY was up 2.6%. So if this was a true short squeeze, I would expect the IWM to be up more than the SPY, more than the Qs, because most companies that are shorted are small cap companies. That's where the majority of shorting takes place. Now, bigger companies, sure, Tesla's been shorted a lot. But for the market, for this to be a full-blown and a short squeeze of the actual market, small caps need to be leading that rally. So that's one little thing that's missing, which could be set off, right? With a rapid rise like today, I think a lot of it had to do with algorithmic trading. 3,500 was a trifecta of support, just like the summer rally's resistance in the middle of August was a trifecta of resistance. We had a trifecta of support here, which then led to computers saying, bid this baby up. And then on top of that, a short squeeze taking place as well. But this could definitely start a short squeeze because there's a cascading effect that occurs. When you're shorting the market and then you have to cover that short, you're shorting more, which can cause the market to just, boom, go up even more. So I see your point here. That could be a potential path. I also think that this could have been a one-time event. The computers just got overwhelmed and they bid it up. All right, this could be a bull trap. Absolutely. If this is a one-day event, and I hate to keep bringing the seasonality chart back into this, but on the seasonality chart, we have that sell-off in the middle of October. I know it's not precise on the day. If it did, boy, could we make a lot of money. But it is relatively, when you put it into perspective, pretty spot on. But it says, and again, this is going back to 1946, midterm election year, a Democratic president's first term, but second year in office, okay? Middle of October, we go, we make a new low for the year. We made a new low for the year yesterday. But then right after making that new low for the year, there is a bounce. But shortly after that bounce, I mean, you can see I don't think I can make this too much bigger. I can't actually, it's as big as it can go. There's a tiny little bounce right here from making that new low for the year. But then after that little bounce, then we have a bigger sell-off that leads to an even deeper low for the year. And it's actually the low for the year at that point. So I hate to keep bringing up this chart, but it's just been so spot on. I almost feel like it's a disservice if I don't. So this could be a big bull trap. I believe it could. Banks could tank us tomorrow. Financials have a big weighting on the SPX and the SPY, just like energy does as well, with their earnings and guidance tomorrow. See, Jamie Dimon, I said at the very beginning of this live stream, Jamie Dimon came out again today and made another comment that, whoa, 2023, we're going to see a recession. It's going to be rough. But he also then said that the consumer right now is handling inflation okay. And he doesn't think that the consumer is going to get bogged down with this inflation until 2023. So if the banks come out and they basically provide a backstop for that comment, that, hey, the consumer is okay right now, they're handling it, but we do see a problem in the future, that could be a problem. But one thing to point out too, to go with your earnings tomorrow and banks tanking us, there are several banks that report tomorrow before the open. That's going to be very important for how this market works tomorrow. Also, on top of that, we have an inverted yield curve right now. That does not help margins for the banks. The banks borrow short-term and they lend long-term. And with short-term rates being higher than long-term rates right now, with the 10-year and 2-year yield curve being inverted, then the bank's not making all of the money that they could be. So that's one thing to also have like as a little note as well. So I definitely see this could be a one-time event because it was a pretty substantial move today from top to bottom. Let's see here. Let's throw this one up here. I'm scared with FOMC next rate hike as inflation is not coming down as they expected. What else can they do? How far can they increase? All right, let's go back here to the CME Fed Watch tool. You can go to cmegroup.com and that'll take you to the website with this tool, or just do a Google search, CME Fed Watch tool. And usually it's the first link. So right now, the market is saying, well, there's a 96% probability of a 75 basis rate hike on November the 2nd. So November the 2nd, 2 o'clock in the afternoon Eastern, there will be a press release and it will say what the rate hike will be. And then 2:30-ish, Fed Chair Powell will come out and he'll give his speech. He'll give his talk. And he'll give his reasons for why they did what they did. Now, like I mentioned a few minutes ago, it would not surprise me at all if the Fed does a rug pull and does a full 100-point basis rate hike. I would not be surprised. Inflation is sticky. Inflation is broad-based. It's in everything. There are pricing pressures all throughout the market. And it's causing inflation to stick around. The supply chain not being worked out yet, right? That's causing more inflation. That's causing inflation to stick around. We saw it yesterday. And in yesterday's live stream, I said that I feel like today's CPI report will show higher inflation. that inflation is sticky and it's hanging around, because yesterday the producer price index showed the same thing. But I did not expect the market to react the way it did today. That's why I had to dive into data and charts and try to figure it out. And like I mentioned at the beginning of this video, all the different reasons for why I think today played out the way it did. So don't be too scared. Right now, the Fed with their rate hikes, they are shocking the system. And unfortunately, with their rate hikes, they're going to go too far, too fast, and they're going to break something. That's what to be on the lookout for. Something may not break in 2022. The economy, it could hold the rate hikes throughout this year, especially if they come out and do a 75 basis point rate hike at their November 2nd meeting, and then another 75 basis point rate hike at their December 14th meeting. That'll put us just over 4% by the end of the year. If they go to 4.5%, which could be a probability, I don't know if anything will break quite yet. But this is the fastest rate hikes have gone up in my lifetime. Paul Volcker, back in the 80s, when he sent rate hikes up, when he sent the Fed funds rate sky high, he doubled it. He went from 10% to 20%. Fed Chair Powell, in the last meeting, quoted the title of Fed Chair Volcker's new book. He quoted the title of Volcker's new book. If that's not a signal that Fed Chair Powell wants to do what Paul Volcker did, I don't know what else is. But they can hike rates as high as they want to. Okay? They can take the Fed funds rate as high as they want to. But if they continue to go too high, too fast, they will break something, and they are conscious of that. The UK, it's been in the news, in the headlines recently, even just today. But for the past few weeks, what's been going on with the UK's bond market has been affecting our own stock market, bond market, currency market. The UK nearly had something break in their bond market. That's why the Bank of England had to step in and start buying UK bonds to help put money into the system, just like if our Fed did a U-turn and stopped quantitative tightening and started doing quantitative easing. But our Fed's not going to do that. Inflation's going up, not down. Our Fed will keep tightening, keep raising rates until something breaks. Let's see here. I agree. I think we will make one more leg down before we start trending up again. Yeah, it's there on the seasonality chart that maybe today is a one-day event. That's a possibility. I mean, the market rallying like it did today just doesn't seem logical with the data that we got today. So that's why it seems very algorithmic, why it seems very short squeezy for what happened. And, we got that new low yesterday. We got that rally. And then, boom, there's a new low that undercuts 2022. And it's the low. It's always a possibility. So that's why I like to reference what the seasonality chart is. And again, it's the red line that we have to follow. And it's been pretty accurate so far this year. That chart is a great tool and indicator. It is. It definitely is. Let's see here. Let them break something. I need cheaper prices. Yeah, a lot of smart people, right? They are cautioning 2023 as a year that, it's not going to be so good for our economy. And if the Fed can't get inflation to go down, I mean, the Fed has said multiple times over the past couple of months that they need to see data that shows that the inflation rate is going down. If core CPI shows that inflation is going up, then there's no way the Fed will pivot and either take a pause on rate hikes or start to truly pivot and bring the rates down. No, they're going to keep the terminal rate there for longer because they want to see data, and the data that the Fed uses, like core CPI or the PCE or the PPI, all these acronyms, most of them are lagging indicators. And if you're using a lagging indicator to fix something that's happening right now today, then you are bound to break something. It's like this. Let's put it into perspective here. Let's say we're building a bicycle. We've got the instructions, we've got all the parts, but instead of starting at step 1, let's go all the way to the end and start at the very last step and work our way backwards. We're bound to get something wrong. Actually, a bicycle might be a little too easy to figure out without instructions. Let's take a piece of furniture from IKEA. That might be a little bit more difficult. We might end up with a handful of bolts and screws and nails, and who knows what we'll end up with. But we're bound to not put it together right. That's what the Fed is doing right now with using lagging indicators to fix a problem that is right now happening today. And that's inflation. That's what's happening today. So, the more that I think about what the Fed is actually doing, the more that I believe that we run a risk of deflation. Not inflation, but deflation. Because if they tighten too fast and for too long, and they use lagging data to do it, which they do, then when something breaks, like we can go back to the 2000s and the dot-com bubble, stocks broke, the stock market broke, and it tanked. We can go back to the great financial crisis, right? The housing market broke, mortgage-backed securities. What would happen if we are just creating a bigger and bigger bubble, and this time around, we break our bond market? What if that's what happens? What if that's what truly happens? Let's look at the 2-year US 02Y on TradingView. This is a steep, steep rise. It was only back in August, we were thinking, okay, maybe 3.25, 3.27, maybe that is a good lid for the 2-year. It found a lot of resistance there. And just to help identify, that's this time right here. Well, then towards the end of August, we got a little bump, and then we started to flatten out here. But then middle of September to today has been a big run up. Sure, we took a little pause, but this right here, this was a bull flag. We had this huge rally, then we started to flag, and now we're rallying again. The 2-year is at 4.46% right this second. If our bond market breaks, if it can't handle the rates going up, maybe we run out of liquidity. Maybe our banks start to run dry. Maybe those are the things that start to break. That would be something else. I have no idea how that would look in the market. We would definitely be headed lower. Okay, let's see here. Let's get this next one up on the screen here. Isn't there something going on in the UK that could have an effect on our market for tomorrow? So tomorrow, the Bank of England is going to, all right, let me back up for just a moment. The pension funds almost cracked under the pressure in the UK last week or the week before. I can't remember the exact date when this occurred. But it caused, I think it was 2 weeks ago, but it caused the Bank of England, who was basically doing what our Fed is doing, but on a smaller scale and not as fast. The Bank of England had to start putting liquidity into their bond market. They started buying gilts, which in America, that's a bond, okay? And they started buying those gilts on the open market, just like if you started to, buy bonds yourself. So they had to put billions and billions of dollars into the market, buying what is equivalent, which is like our bond in the UK, to help support the market and not allow the funds over there to start cracking. Tomorrow is the date that the Bank of England stops buying those bonds or gilts. So, if the UK market can't handle liquidity not going into the market, then there could be a problem in the UK. Maybe the British pound starts to fall. Maybe yields start to spike because their 10-year gilt fell 33 basis points today. That's a big drop. I mean, look at the candle here for our 2-year note. It was up, let's see, where is it? 17 That's percent. Where's the number? TradingView. Anyways, it was up 4% on the day. I can't see for some reason where the number's at. I'm losing my mind. I need my glasses. I don't have them right now. Anyways, today's move, it wasn't nearly as big. Okay. Sure, it was a big move for our 2-year, right? The last time we saw a move like this, we've got to go back here to the 13th of September, which was nearly a 5% move. So you are correct. That happens. Oh, there's something else that I forgot to mention. Today, for the SPX, I forgot to mention this yesterday, and I forgot to mention it earlier. We had options expiring today for the SPX. When options expire, that can help be a magnifier for a particular equity or indice. So that did help the SPX. Not a big thing, but that was something that happened today. Let's see here. Effect or effect? I always screw that up. I do too. Let's see. Effect with an E, I believe, is the thing that causes something to happen. Effect with an A is the aftermath of that thing causing something to happen. I think that's how the E and the A works there. I'm not an English major, so and I'm definitely not a very strong speller, but I think, let me know in the comments if you know. I think that's how the E and the A work. The E is the thing that causes something to happen. The A, in effect, is the aftermath. At least that's what I remember. A for aftermath, A for the effect. But I don't know. I could be wrong. I could be wrong on that one. All right. What other question do you guys have? If you have some, plug them in there. We can keep rolling with this. If not, we can start to wind down. I went through all of my notes that I wanted to talk about today. Tomorrow being Friday, it looks like the options market is going to nail this one just right for 2 weeks now in a row. And this thing lands right within the weekly expected move. So let's just go over those because they are important. As you see, today was the lower end for the SPX was 35.15. The upper end is 37.63. Now, there is a couple of things that are going to keep a lid, I think, on how far this thing could come down. We do have a trend line, okay? Let me bring this thing down and line it back up. We do have this trend line here. All right, come on. There you go, right there. And this trend line, I need to bring this down just a little bit here so you can see it. This trend line starts at the peak of the summer rally, okay? That's where this trend line was started. It acted as resistance here. It acted as resistance here, though the next day it did jump over it. But then the following day, it gapped back down to close right under it. It also acted as resistance right here. Now, we had an island topping pattern, and that's what this is. Let's open this up a little bit more. These 3 days right here, we had a gap up, okay? And then we had those 3 days basically moving sideways, and then we had a gap down. That's an island topping pattern, right? So we reached that. I don't know that we're going to break this trend line right here. And let's see. We also, with this trend line right with it, we've got the 20-day moving average coming down with the trend line. So we've got a couple of things right there that could pump the brakes on this rally that we saw today. If we go to tomorrow in this trend line, it puts it right about where today's high was. 36.81 is where that trend line is. Now, again, this trend line is just a what was our high today? 48.8. What? No, I looked at the high. 36.85. And what did I say tomorrow was 36.81. So almost right there with the high of today, which happened towards the end of the day. So we do have that in the 20-day. That's two things. It's not a trifecta like our support that we have at 3,500. So we do have that to look out for. Let's see here. Let's also, I'll go to the SPY too and check that out. Okay, so could the market move higher? Sure. There's always that possibility. I don't know. After today, I am skeptical as I'll get out about what could go on tomorrow. If the market is irrational and we've got the dollar already moving up in the after hours, if the dollar does go back up, if the 10-year does go back up, because we had sticky inflation today, maybe the reality of what happened today finally gets into the market and like, oh, whoa, sell into strength. That's been a mantra of this market for the whole of 2022. Sell into strength. That's what could transpire tomorrow. We could have a big sell-off because of this big run-up right here. Now, another thing to point out is the level where it's at, okay? This level right here where it closed, 36.69, okay? That lines up with right here, the top of those candles, and 36.69 also lines up with this support right here, okay? So if we back up to when we had this giant sell-off right here, 36.69, 36.70 acted as support to stop all that bleeding. And that was the turnaround point for the summer rally. Now, what does old support do? Old support turns into new resistance. And it's been acting as resistance through here minus 1 day that it got above that mark. So we've got that resistance line there. Maybe we do have a trifecta here for tomorrow, where the trend line's coming down, the 20-day moving average is coming down, and we've got old support that is now new resistance. So that doesn't look all too well for tomorrow, quite frankly. Just looking at the technical structure here of the market. Let me clean this up and we'll go take a look at the SPY. Thank you guys for all of your support and questions today. I greatly appreciate it. I just want to make sure that you know that. If you want more perspective, click the first link in the description. You can help out the channel and get a ton of awesome content and helpful bits for your in investor journey. So click the first link in the description to help support the channel and get a bunch in return. I like to under promise and over guarantee. So you'll see that. Okay, here with the SPY, we've got all the same trend line stuff happening here. All right, let me just clean these old highlighter marks up. And I'm going to go look at the 15-minute chart. because that'll also give us an indication. So we have that same trend line that started at the summer top, the summer rally high, okay? The same resistance caught here, caught there, caught there, and caught here, also coming down. We have the 20-day moving average coming down. We have that same old support is new resistance, okay? All for the SPY there. So we've got that. Now, that price point, let me clean this up a little bit here. So that price point for tomorrow is right around 367, 365, maybe as high as 370. So give yourself a zone there, 365, 370. Watch out for any resistance in that area, okay? If it can break above that and hold above it, that would be an interesting level. Now let's go look at the 15-minute chart here on the SPY and see what we can uncover. I got to fix the chart right quick. Yeah, look at that, man. The thing's been coming down for several sessions. That island topping pattern, like we talked about right here, this was the island topping pattern where we had the gap up, move sideways, and a gap down. That is a topping pattern. All right. So now let's open this up a little bit more here. So the gap down from the island top, we need to pay close attention to that level. So right now, oops, I moved too quickly. My chart hadn't finished moving. So right now, that level is sitting at, let's see here, 368. So on the daily chart that we were just looking at, I said between 365 and 370. That lines up with the island topping pattern 2, where it gapped down to, okay? So that is going to be a key area to watch out for. Now, with today's giant move, talking about a flagging, you could potentially let's see here. Okay. All right. So there's also an area that's interesting here that could be an area to watch to see if it breaks down from. So if we look at that mark right there, and then we come over here, we mark that right there. There was support there. There is an air gap in the volume shelf profile over here. You know, it spikes out, it goes back in, and then it spikes back out, goes back in. When you see those, the volume shrinking and going down, those are the areas that price can just gap right up through. So I know that's a horrible line, and it really can't see anything, but the price point right around the 362, watch out for support right there, because as we look at this, we had 4.5 million shares trading hands at this price point, 362. We had 3.1 million buying versus 1.2 million selling. So 362, that's where you need to watch for support coming in tomorrow, okay? If that 362 area holds, that would be a positive development for tomorrow, okay? So watch, you know, like the 365 to 370 as a zone of resistance. If it can't break above that, then watch for that 362 as support to see if that can be held. Those are your two areas to be on the lookout for tomorrow when it comes to price action. All right, let's just clean a couple of these things up here. There we go. All right, I'm going to go back to the daily. Then I'll go look at the Qs, and we'll see what price points we need to pay attention to for the Qs tomorrow. All right. So the lower end of the weekly expected move is 350. The upper end of the weekly expected move is 375. So if we do get running, that would be another area to watch for resistance. All right. Let's look at the Qs here. Obviously, this is set up a little bit differently than the SPX or the SPY. Okay. So the Qs also have that same resistance coming down here. That trend line resistance where it caught the top there. And then it was resistance on the way down. It's got that, and it's got its 20-day moving average coming down. So it looks like 270 is an area to watch for resistance. But let's go into the 15-minute chart to look at this a little more closely to find some areas that we need to watch for tomorrow, to see if this rally can be sustained, to see if there's follow through. Okay. So for the Qs, there's a bit of a pocket from where it is right now at 268 down to about 266. There is a pocket there. So that price point is real squishy, okay? There's not a lot happening there. But anything above 269, 270, there's also like nothing happening there. That's an area to definitely watch out for. And if we look at where we have the same island topping pattern, where that ended up being was 275. There's not a lot happening in that zone right there. So definitely be careful. Anything above that 270, which acted as resistance today, and there's a good reason it acted as resistance and stopping it where it was today, is because if we look at this volume shelf profile, that's like basically where it starts, and then it runs up to an angle like this, and then there's a big gap right here and a lowering in price. So there's plenty of support. Let's go down to the average price point right here, which is down a little bit lower. There's a red line right here, and that's coming in at right about 263. And that saw 1.9 million shares trading hands. 1.1 were selling. Only 869,000 were buying at that price point. So we got to be careful there. So again, 270 is kind of like a max right here on the Qs. If it can break that, then that would be positive, 270. But really, things have got to go down to about 262 before there's some support stepping in. And, you know, that's basically where things were at yesterday as support. So watch out for those two price points. And then the lower end of the weekly expected move is 257. The upper end is 280. All right, let's just go look at the IWM real quick, and then we can wrap up this show. Again, thank you all for joining me today. Do me a favor, though, before we look at this. Can you click that like button? Only takes a second, really helps out. And of course, if you could share this video with a friend, that's also extremely, extremely helpful. Okay, so man, there's not a lot for the IWM up here as far as price goes. There is a single bar sticking out here at about the 171, right about where it closed. And then there's a big air gap there all the way up to 173. So if a short squeeze does get kicked off tomorrow, it would be nothing for the IWM to kick up to 173 from where it's at right now, because there's like hardly any volume trading hands right there. And then support is right about 170. So watch 170 if it can hold 170. If not, then you can see on the volume shelf profile right here, it kind of goes out like this and then falls right back down. That peak is somewhere around 167 up to 168. So that couple dollar range there, that's kind of like the peak volume for IWM in that price movement. Okay, so watch to see if it can break above 171, 172 as a bullish sign. And you need support to step in at 170. Otherwise, it could sink lower. So those are your key areas to watch. The lower end of the weekly expected move is 161. The upper end of the weekly expected move is 175. So it looks like we're probably just going to end up for all the major indices closing spot on right within those weekly expected moves. So we've got that going for us. Okay. Well, I guess we've reached the end of it here today. I do find it interesting, and I should have mentioned this earlier, with this big move in the market today, what happened to crypto? Why is Ethereum still at, $1,200, almost $1,300, and why is Bitcoin at 19,000? That's very interesting to me that neither one of those really moved that much. You would think with a big rally that, man, it should have, right? But I also find this interesting too. You guys know my drawings here have been on the screen for months. I do find it interesting that where I've drawn out here, where Bitcoin could base, it's being held up really, really well. And for Bitcoin, right about the 18,500, a ton of support at that price point. There's also quite a bit of support. Let's see where this would put us. Right about the 2,000, I'm sorry. Whoa, not 2,000, 20,000 range. So right between there, there's a bunch. It's like it pops up above 20, it gets sold, it dips down to 18,005, and it pops back up. That is good base building right there. So even though it didn't move with the market today, I like that it's holding up relatively well compared to all the dips going on and all the pops and all the volatility, right? All right, well, we'll wrap it up. I'll be back here tomorrow live after the market has closed to talk about what happened, why it happened, and what to expect. Tomorrow, again, my confidence for tomorrow is a bit lacking. I'll put it that way. Today shook me. Honestly, it did. I expected the support at 3,500. I did not expect such a huge rebound. And I've said that multiple times during this live stream. So it does have my confidence shaking just a little bit for tomorrow. But I gave you the key points to watch out for on these major indices. You got the weekly expected moves. So just keep the risk tight. Keep your risk under control. Go with small position sizes. Let your winners run and cut your losers loose. Make sure that you are using a trailing stop loss, or if you're not using a trailing stop loss, make sure you are constantly moving that stop loss up to keep that risk tight. All right. I too am going into a bullish tunnel vision mode. You are welcome as well, and I greatly appreciate each and every one of you. I really, really do. This live stream is for you. It's the whole reason I do it. So thank you for joining me. Make sure to click that like button, share this video with a friend, and yeah, if you want more of this perspective, click the first link in the description. I think you would be happily surprised. All right, ladies and gentlemen, we'll wrap it up here. Thank you so very much, and I will see you in the next video. Have a good night.